Straight up Chicago investors, welcome to another Straight Up Tuesday tip. I'm 𝗤𝗃𝗃𝗀𝗃. With me as always is Mark Ainley. And with us again is Erick Workman from Renovo Financial. Erick, welcome back to the show.
Morning, guys. Thanks for having me.
Good morning. All right, so we're going to talk about long-term commercial financing here. So I know a lot of you might be house hackers and putting properties in your personal name, or you haven't maxed out your 10 Freddie Fannie bullets. So this might not be on your radar today, but it's good to know as you scale, because at some point you're going to run into DTI issues. You're going to go past your 10 properties. You're going to buy a unit, a 6 unit, an 8 unit, a 12 unit where you need to do commercial financing. And you need to understand how this works, because it makes up the debt service makes up such a large portion of the expenses. And you need to understand all the risks that go along with that. And today we're going to talk about long-term commercial financing that is actually fixed for 30 years. And Mark, I know we talked a little before the show, like, this is amazing. Can you just talk about, 7, 8 years ago when you were starting to get into commercial financing, just what your terms used to be compared to having something that would be fixed for 30 years?
Yeah, so this didn't exist. That's why it's so easy to refer someone like Erick and Renovo, because I get Giddy talk about it. And even over the last couple of years, their products have changed to even get even better. So, what I found with Renovo a few years ago, and I have a few loans, was really exciting to me at that time as well too. So, like Tom said though, what you're doing today or tomorrow or down the road, this is an important conversation you pay attention to. And based on the market right now and the opportunity you have to get into loans like we're going to talk about today, there might be strategic moves you make today to hedge your risk over the next 10 years as well too. So Erick, we'd love to kind of let you kick it off here and give us the rundown.
Sure. Well, thanks for all the kind words there, guys. Appreciate it. What Renovo is benefiting from the creation and the existence of a market that didn't exist before. Mark, you and I have known each other for almost 10 years. And sometimes I look at the loans that we're able to offer and just wonder how many hundreds or thousands of units we might have been able to put together back in the day if debt like this existed. But look, you make hay while the sun shines, and it's shining now. And so we've got a lot of mutual clients here that are benefiting quite a bit from it. Tom, you really hit on it. There's a lot of folks that listen to your show. They're house hacking right now, or they're focusing on 1 to 4 unit properties. Maybe they've got a good W-2, and so they've got good income, and they're able to get conventional financing on these rentals. And that's great. I tell folks all the time, if you're able to take a rental property and finance it conventionally, there's no reason not to go get 3% money for 30 years on a rental property. By all means, go get it. But it's rare that I run into an investor who's serious about growing their business or their portfolio, and they say something along the lines of, well, like, I'm probably going to stop at 3 or 4 properties, or I'm going to, I'm never going to own anything bigger than a 3-unit building or a 4-unit building. Most people, as they grow their business, they grow the number of properties that they have, they grow the number of units that they try to attract, and they eventually graduate out of being able to qualify for conventional financing. Conventional financing focuses a lot on your debt to income ratio, and you can have a really, really, really good job. You can be a $200,000, $300,000, $400,000 a year earner, and it's hard to qualify for 6, 7, 8 rentals, just in your personal name. And that's where kind of the creation of this market, where now we can offer 30-year fixed financing on really anything from single family homes all the way up to 30, 40, 50 unit apartment buildings. The creation of this market has allowed real estate investors to grow their business, refinance things out of their personal name, be more active in going after larger properties, et cetera. It just really kind of opened up the mom and pop investor into the commercial real estate market, where in the past it was so much more difficult for them to obtain financing.
Yeah, that's awesome. I think another thing, just a quick point here as well, is if you're going to be doing rehabs, if you're doing a rehab and then you're putting your personal name after the fact, it's a cash out refi rate. It's not going to be that. It's going to carry that premium with it, and that premium is heavy right now in the market. There's a big arbitrage between purchasing a 4-unit and doing a cash out refi on a 4-unit in your personal name. Like those rates are a lot higher. So if you're someone who's going to get your hands dirty and do some sort of rehab with an acquisition loan or cash or whatever, I ran into this personally on my 4-unit, where the 30-year product fixed in the LLC's name was actually less expensive than going the route of putting it in my personal name. And then for me personally, the headache of just having to show my bank statements and all the money coming in and out from the flips. But like just the actual on spreadsheet numbers, it actually ended up being more competitive.
Maybe you could speak in general or to Renovo's requirements, but when you're doing these type of loans, is it a requirement to have an LLC name, or can you still hold it in your personal name?
It is. Yeah. So, here's the thing about this particular product, let's say, like the regular conventional financing market, in the conventional financing world, whether you do a loan with guaranteed rate or Quicken or Pearl Mortgage or any of the big, financing shops out there, pretty much all loans end up in the same place, right? They all kind of get originated by whoever's going to, whoever your loan person is. They all get packaged up and sold down the river, and they end up in New York somewhere and kind of dumped into this big securitization ocean, right? That's the way the conventional financing world works. The commercial mortgage-backed security world works very similarly. And so you have big securitizations that happen with loans like this. And now you have originators like Renovo, or even some of our biggest competition out there, the 𝗬𝗵𝗶𝗵𝗁, Finance of America, Lending Home, et cetera. We all end up effectively packaging these loans together, kind of moving them down the river and dumping into the securitization oceans that happen, out in the world there. So the creation of this market has kind of driven the ability to offer these products, but really what you end up having is relatively similar types of pricing and structuring that's going to happen nationwide, because everybody ends up selling effectively into kind of the same types of pools.
Makes sense.
Yeah.
So Eric, let's talk through then what are the qualifications? What are the items that make up what your terms are going to be on a loan like this, on a 30-year fixed commercial loan?
Sure. Great question, Tom. I get a lot of calls and referrals where people say, hey, what's your rate? And I tell them, look, I understand the question. Certainly it's a very important thing. We'll definitely get to it, but I need to ask typically 7 or 8 questions before I can zero in on a rate. And I've seen what some of our competition does. They'll send guys emails and they'll have these big charts and, LTVs on this side and credit scores on the other axis. And, you zero in right there and there's your rate. It's way more complicated than that. And I can't believe that some of our competition gets away with, putting rate sheets out that way. But there's really 7 different elements that go into pricing a loan in this space, in order to kind of zero in on where a particular client might fall. So the first thing that I always ask about is credit score. And the commercial real estate world acts very similarly to the regular residential real estate world, in that loans price based on credit score. And there are breaks in pricing at 680, 700, 720, 740, and 780. So there are 5 different tiers of pricing that occur inside of these loans based just on credit score alone. And, most investors out there, even if they're new, they understand the concept of risk-adjusted pricing, right? And so you get better terms for what appears to be less risky loans. When these big institutional investors are buying these packages of loans, they look at, average credit score and average loan to value and, cash flows inside of these pools of mortgages. And, they'll accept lower interest rates for higher quality loans. And the first thing that really gets priced out is credit score. The second thing is loan to value. And this should just make common sense, right? The financial crisis happened and you had a lot of people who were buying properties at, 100% loan to value, or in some cases even higher, more than they were getting loans for more than what the property was worth. Congratulations, Mark.
I got a lot of loans that should have never been given, but I took advantage of it in a good way. Keep going.
All right, there you go. Really anything under 55 or 60% is going to get priced about the same way. But then as you start ratcheting up in loan to value from 60 to 65, 65 to 70, 70 to 75, you're going to end up with different breaks in pricing. So, and that's all just in relation to if something goes bad in this loan, is the ultimate end owner of that loan, market drops, client stops paying, how secure is their position? How likely are they to get their money back if they have to liquidate the property? Makes relatively common sense. The third thing that we take a look at is loan size. Believe it or not, the larger the loan, the more likely you are to get pricing breaks. There's a desperate scramble for places to put capital out in the world these days. We as a country, printed $4 trillion over the last, year or so. And there's that money's kind of floating out there. There's a lot of liquidity in the market. And there's a lot of places. There's not a lot of places to put it. And so the more money you can get out, the larger the loan that you can offer, the better pricing that you'll get. The fourth thing is prepayment penalty duration. So for the listeners out there who aren't super, I guess I would say, familiar with this, if you get a regular conventional loan through Guaranteed Rate or any of these other places, typically there is no prepayment penalty with it. If you decide to pay that mortgage off 3 months, 6 months, a year later, no big deal. In the commercial world, it's a big deal, right? People are buying these packages of loans because they believe they're going to see the cash flows off of you making your payments for years on end. And so there are prepayment penalties that come along with these commercial mortgages. Our general prepayment penalty is 5, 4, 3, 2, 1. And what that means is, 5% of the loan amount. If you pay the loan off within the first year, you owe a 5% of that loan amount penalty. 4% in the second year, 3% in the third year, 2% in the fourth year, 1% in the fifth year. And then after 5 years, you're home free. And that's sometimes you'll hear people call that yield maintenance, but really what it is that investor down the river who bought this package of mortgages, they're expecting to receive these cash flows. And if you pay it off early, then they get the benefit of it. So if you build a loan with a 5, 4, 3, 2, 1 prepayment penalty in it, you're going to have a lower interest rate than if you say want a 3, 2, 1 prepayment penalty. Or in some cases, if you request no prepayment penalty, then your interest rate is going to be substantially higher. Really what it is it's security of cash flows for the end investor, and how likely are they to continue to get that coupon is what goes into pricing. That's 4, right, guys?
That's 4. And just comment there, make sure you want to hold this thing, right? That's a steep penalty. Make sure that's in the game plan. You're not going to refi this thing in 2 years. That's, you need to understand if this does or does not fit into the long-term goal of the project.
Well, I think into the long-term goal of your business, right?
Yeah. Are you a true buy and hold person here?
Right. Yep. And is the property something you want to wake up in 10 years and still own?
The dichotomy of that is, though, if a neighborhood changes and it goes up so high that a 2 or 3% on year 3 or 4 is not the end of the world either, though. So you have to calculate that in your risk as well. So if these come into play when
through that. Sorry to cut you off, Mark. I'm actually going now where I'm selling a property. The market's so bananas right now that the prepay is like a rounding error.
To that end here too, the next one is the loan type. So all the loans that are offered in this type of product really across the country are 30-year mortgages, right? So they're 30-year terms, they're 30-year amortizations. There's no balloon associated with them, but there is a different type that you can pick inside of this. It has to do with how long your interest rate is locked for. So we have 5-year, 7-year, and 10-year ARMs, which means the interest rate is fixed for 5 years, 7 years, or 10 years. And then we also have 30-year fixed, where the interest rate stays the same for all 30 years of the loan. The whole reason that you might choose one of those, a 5-year ARM interest rate is going to be a little bit lower than a 7, which is going to be a little bit lower than a 10, and a little bit lower than a 30-year fixed. There's not a huge spread in the market right now between, like a 10-year ARM and a 30-year fixed. So most of my clients have been picking 30-year fixed. But if you believe that you've got a 7 to 10 year, hold time on this, some of my clients have funds where they are, the fund calls for them to sell it in 7 years or 10 years. Then, they'll select a little bit lower interest rate. They'll select a 7-year ARM or a 10-year ARM. Because there's no reason to pay the premium for 30 years because the likelihood that they hold the property for all 30 years is very, very low. But, others think about, they've got young kids, and when they go off to college, they're going to want this thing paid off, or they're going to want to refinance it here in 18, 19, 20 years in order to pay for college. That's another business plan too. And folks are picking the 30-year option. Number 6, Tom, you mentioned this earlier, cash out versus rate and term refinance. So if you're refinancing a property and, let's just, for simple math, say it's a $400,000 property and you owe $200,000 on it. If you just want a rate and term refinance where now your new loan is also going to be $200,000 and you're not taking any cash out, the interest rate for that is quite a bit lower than if you want to now put $300,000 worth of debt on it and take $100,000 of cash out. And really, again, it all goes back to kind of risk-adjusted pricing. The more equity that you have in a property, especially the more cash equity you have in a property, the more comfortable the end lender feels about your commitment to the loan and to the ongoing payment of it and to the condition of the property, and the better pricing that you're able to get. So cash out versus non-cash out is a big factor when it comes to pricing. And then
Erick, quick question before we move on there. Let's say, a lot of people are looking to BRRRR these properties. So let's say you buy something for you have $50K of rehab, so it's $250. It appraises out at $4. You're looking to get that $250K back. The loan might not be $250, right? Like your initial loan might be $200. You had to put $50 down at the beginning. If I'm looking just to get my money pulled out there, is that a rate term or is that a cash out? Because I'm cashing out higher than the initial acquisition loan.
It's cash out. Got it. Yeah, it's a cash out. Now, the market's also moving in a way where, depending upon how long you've owned it, the maximum amount you might be able to put on that property is the $250. There's a lot of shops out there that are willing to go up to 100% loan to cost, right? So you're in that property for $250. They're happy to give you your $250 back, but the market's moving pretty fast right now. A few months ago, you could rip that thing all the way up to $300, take all of your cash plus some out. And that's kind of come back to earth a little bit. So if you've only owned the property for a few months. Now, if you've owned that property for a year, 18 months, 2 years, no problem. Go right off of the loan to value. But in that example there, getting your $250 out would be 100% loan to cost, and it also would be considered cash out. But the flip side of that is, on a $400,000 property and you're getting a $250,000 loan, you've got a 62.5% loan to value. And I mean, that price is fantastic, right? Yep. So if you've got good credit and that property cash flows well and you're at a 62 loan to value, you're going to be sitting really nice.
Makes sense.
All right. And the last and final thing, is debt coverage ratio. So I imagine either in one of our prior shows or somebody you guys have had on, you've gone over debt coverage. But really, if for those of the listeners out there that aren't super familiar, debt coverage is really just a factor of how well the property cash flows. So you take your total rent, you subtract your expenses like property taxes, insurance, property management, vacancy, repairs and maintenance, et cetera, and you get your operating income. And you divide your operating income by your debt service, by your principal and interest payment. And you want that quotient to be above 1 for sure, right? Because otherwise your property is going to cash flow negatively. But a lender, the way a lender looks at it, we really have 3 tiers. You got to be over a 1 or else you really don't qualify for the loan. If it's over 1.2, then great. You've got a pricing break. And if it's over 1.3, now you're into a category where you get an even better pricing break. So debt coverage for the asset is a key component to pricing these loans versus, say, your individual DTI. In the conventional mortgage world, lenders are worried about your debt to income ratio. Like, are you personally able to make this payment? In the commercial world, DTI really doesn't come into it. What we're worried about is the property able to make its payment?
Makes complete sense. When calculating that debt service coverage ratio, we don't need to get into the complete nuts and bolts here, but are you guys including some sort of percentage for vacancy, maintenance, et cetera, right? Like, it's not just, well, here's the hard cost. Like, and I know each lender is probably different.
Yeah.
Can you just give like a rough idea to our listeners without getting too in the weeds? Sure.
On a 1 to 4 unit property, it's really taxes and insurance and any homeowners association dues. Those are the expenses that we calculate. Anything 5+, we take a vacancy factor, generally anywhere between 5 and 10. And that's really dependent on what the appraiser tells us is commonplace for the market, for either the market or the submarket where the property is located. And then based on how recent any renovations were to the property or the age of the property, we take anywhere from 0.5% to a full % of the loan amount for annual repairs and maintenance as an expense factor, on top of property management, taxes, insurance, et cetera.
Yeah, no, I just want to add one more point here based on my experience. I went through this about 4 years ago, where I took 4 of my buildings and I had, 5-year ARMs with a community bank on it. And I moved 3 of those 4 to 30-year terms. And some of those things I was thinking about when I was calculating it out is, if I could continue with my community bank, who I had a great relationship with, I could continue to refinance every 5 years. I'm paying fees every 5 years to refinance. I'm getting a new interest rate every 5 years. And I am also leaving risk out there for if one of these 5-year terms comes up and all of a sudden the bank doesn't want to refinance me. So I moved 3 of these 4 properties. I sold the 4th to these 30-year fixed. That way I could control my destiny. I watched so many people in 2009 to 2011 get burned because their 5-7 year term rate or term loan came up due. And their bank that they might have been doing business with for 30 years said, you know what, our hands are tied. We can't refinance, or we'll refinance you, but you got to bring another $100,000 to the table to recapitalize yourself. And a lot of those people walked away. A lot of those people lost a lot of sleep. And I just like the concept of being able to not have to worry about, you have that property, you love that property. If you're going to keep it, then set yourself up. Now I had to make the decision, and I ran these numbers, for the community loan I had in the 5-year term. I think these were numbers a few years ago. I think I was around 5.5%. And when I refinanced and went with Renovo, and these numbers are higher then, which was still attractive, I think I went to 6.5%. But based on all those costs I would have and limiting all my risk of not being able to refinance somewhere down the road, the numbers just made sense. And I actually came out way ahead when you take in the appraisal every 5 years and so forth. So it's some number crunching, and it's important to control your risk when you're making these decisions.
Absolutely. We can lock in at 4% right now. I feel like, people are going to be kicking themselves 5 years from now. Like, I took the ARM and it was, 0.5 point lower. Like, I don't know. Maybe I'm wrong and maybe rates will stay low forever. But now is the time when there's a chance to lock in at a low rate. Like, man, take it. and maybe we're wrong. Maybe we don't optimize it, but like you said, it's peace of mind. It's you eliminate the black swan that can wipe you out.
Yeah. 2009, 11, like that was the black swan that so many people literally owned these buildings for 30 years. And they, all of a sudden they couldn't refinance and they had to pull money out of their pocket, or some of them dumped them, and some of them were getting towards retirement and just dumped them. And they lost hundreds of thousands of dollars because of that decision they had to make because they couldn't control the circumstances around it.
Yeah. Cool. Good stuff, man. We went long here, but a lot to cover and hopefully a lot of value there. So we'll wrap with the Chicago facts here. And Eric, I went with the golf one. I know you're probably going to know this. So don't blurt it out. Give Mark a shot here. Mark, I'm going to make it multiple choice for you. All right. So I didn't know this, but Chicagoland actually has the oldest 18-hole golf course in America. So Mark, I'll give you multiple choice here. This private club.
I know the city. I know it's in Wheaton, right?
It's in Wheaton. You are correct. So here's your four options: the Chicago Golf Club, Medina, Butler National, Olympia Fields.
It's number one, Chicago Golf Club.
You got it. Nice work.
Yes.
Workman, did you know that? I'm assuming you had that. You're a Naperville guy and a golfer.
Yeah, one of my neighbors here caddied there for like 7 years. It's a pretty special place.
All right, guys. Awesome Tuesday tip. We are getting ready. This will air in advance. We're getting ready for our 100th episode recording. So we're excited about that. If you haven't, go to our website, purchase your tickets. If you are on the waiting list, then we'll let you know, and we will look forward to that night. I'm excited about that recording. It's going to be fun. I know, Eric, you're going to be there. Tom, we're going to have a blast. Great show today, guys, and we will talk soon. See all you guys Thursday.
Thanks all.